Hi, this is Pat with Energy Solution Partners, sharing with your energy market view at the close of business on Wednesday, May 11th. Keep in mind there is a risk of loss when trading commodity futures and options. I want to start today by looking at a couple technical studies that I've been watching on the daily heating oil chart. And looking at the bottom part of this chart is our stochastic study. And this is a measurement whether the market is sitting in an overbought or oversold condition. And anything below this red line to the bottom is considered oversold. Anything above it is considered overbought. So you can see what happened in early April. The market did get in a very oversold situation. And what happened? Um, the market did bounce pretty hard, and we had a nice 35-cent rally through the month of April. So, pretty impressive rally that took place. But looking as we came out of April, where the stochastic study was sitting, and it moved itself up, and we are in an overbought position. So, it looked pretty suspicious that we're ready for a pullback after a 35-cent rally in a relative short time. Everything was set up for a pullback, and that's what did happen in the first week of May. We did get our pullback that took place, and since that time, the last couple of days now, we've bounced the market back higher. Looking at the stochastic study again, we're in a very neutral situation. We're neither overbought nor oversold here. So, as the traders come in, start pushing this market around, it looks like there's more money ready to come back into this market. Looking at some key retracement levels on that rally higher, again, as we rallied that 35-cent a gallon, we measure that to the upside, and then we look at some key retracement levels. The first focus is 38% pullback of that 35-cent rally. Second key level is 50%. Third key level 61%. And that's a Fibonacci retracement, what a lot of these technical traders will be looking at. You can see what happened. We came down. We did hit that 38% retracement, which fully expected. And actually, myself, I thought we would go deeper than that. I was focusing on this 50%, but it didn't happen. We hit this first level and it bounced and bounced hard. So, with that, I think our hopes of pulling back down to that next level, have probably diminished here on us. And the traders look to push this thing back higher again. Getting beyond the technical setup, with some of the chart studies and the wonkiness that goes on there, um, taking a look at the supply demand situation. And one common theme that we keep hearing in this U.S. distillate market is we do have a lot of distillate in inventory. We're well above the 5-year range, which you can see in this gray shaded area here has been the 5-year range, and today we sit well above that 5-year range. We have pulled it down some over the last several weeks, but a lot of people are just focused on these high levels of inventory, and so a lot of talk of the markets can't go much higher. But I'm trying to look beyond that, as the market always does. The market's always looking forward, and not the snapshot of where we sit today, but where does it see itself down the road? And that might even be 1 or 2 years. But trying to get beyond this snapshot of where inventory sit today, I'm looking at the diesel crack spread. And this gold line on the bottom is where the crack spread sits today at $12 a barrel. And this is the margin that a refiner has to turn crude oil into diesel fuel. And today that margin does sit at $12 a barrel. But if we look back over the last 4 years, that crack spread has been in the $25 range. So you can see how the profitability for a refiner has really dropped, and probably not the incentive to crank diesel out today like it had been the last several years. And so that's something we definitely want to keep a focus on, is the diesel production with these low crack spreads and how these refiners will react. Um, with that, then, we do look at production today, as reported by the EIA today. And 2016 production is well below where it has been the last couple of years. So, as we've seen this diesel production fall, and demand has actually been fairly strong here. We have started to watch some of this inventory being drawn down, so that's something again we will be watching on a week-to-week report here. But the trend has been somewhat bullish as we model this out, watching the current inventory start to draw and these lower production levels. Looking at the days of supply of distillate, and we started the year with some very high days of supply, and demand to start the year was actually pretty poor as well. And I think a lot of that was attributed to the warm winter that we had and very low heating oil demand. But over the last 6 weeks, the diesel demand has really picked up, and we can see what's happened in the number of days of supply, and it started to fall at a pretty fast clip here. So again, watching the long-term setup here, if these numbers continue, I think it's looking like a bullish setup from a supply-demand standpoint on the diesel side. And to tie into the crude side of things, the same setup with lower U.S. crude production, and each week we see these inventory reports come out, and looking at the crude production number, and it is getting lower and lower each week, which we fully expected with the drill rigs coming offline, and we've continued to watch the drill rig numbers drop. So with that, I think we can probably look forward to more crude production falls here in the U.S. And we did peak last summer at 9.6 million barrels per day, and today we're down to 8.8 million barrels a day. So we've already taken 800,000 barrels a day of crude production offline here in the U.S., and I think that's probably set to continue with the current situation that we have. So with that, I think the long-term trend probably continues higher based on these fundamentals and looking forward. And with that, I definitely wouldn't be afraid to start looking at some fall coverage if anybody's looking for some diesel for the fall time frame. I know a lot of conversations we've been having. There's been some wait and see attitudes and waiting for a dip. I think that could be a little dangerous, I guess, if you need to get coverage in place. And you can see how quick these dips can happen and go away. Where the first few days of May here, we did have that dip, and in just 2 days, all that dip has disappeared. And so now we're back to waiting on the sidelines. So I wouldn't be afraid of waiting too long to get that coverage in place. And also for 2017, we've had a lot of interest in 2017 gallons. Again, long term, I think this trend continues higher. So I would not be afraid of looking at some of the 2017. As always, if you want to discuss the market situation at all or your individual situation, look at some strategies, feel free to give us a call and we'd be happy to go over that with you. Have a great day.